Well, the day started off with promise as Microsoft, the world's largest publicly traded company, knocked the cover off the ball with their earnings report, and the stock shot to new all-time highs. The rest of the day wasn't quite as exciting for the bulls. We did see midday a report that came out that Iran seized a British oil tanker, and that really started to cause a little bit of nervousness within the market. In fact, that will lead into our trade application example that I kind of hinted at on Twitter here earlier today. So let's go ahead and take a look at all of that news. Let's see how it affected the markets. Let's see how it affects our posture, and let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 19th, 2019. First of all, if you are new, we would encourage you to go over to YouTube, click subscribe. While you're over there, check out our description area where you can sign up for our email distribution list, which entitles you to seeing all the stocks giving you overbought and oversold cluster signals in the S&P 500, in addition to notifying you when these Market Outlook related video posts are available. We also have a presence on Twitter. My handle is @BrandonVanZee. We would encourage you to click like and retweet if you do get value out of these videos and you want to see them continued. Additionally, we have a presence on Facebook. We would encourage you to join our group there in the web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of you. And as a reminder, this is just a 4-grid that can look at all of our major U.S. equity indices side by side by side by side. That allows us to see if there's any differences that are taking place or whether they're all kind of traveling in the same direction. Right now, we actually do have a difference to notify you of, and that is the Russell 2000 has a bearish posture right now. You'll notice that very easily from a visual perspective because the background color of the chart is pink over the most recent candle here today, whereas you can see that we have green background colors over the candles on the other 3 indices. So small caps have been the laggard for quite some time. It seems like we refer to that quite often. We'll talk about that probably here in a little bit as well when we look at their 1040 crossover method. But even in the short term here, we are seeing that the small caps just cannot get a whole lot of oomph out of any of the bounces they've been able to deliver, at least not in the same vein as what we've seen out of some of the larger cap indices out there. You'll notice the S&P 500 was actually setting itself up pretty nicely for what sometimes we refer to as a hold or a close above the high of the low day when Microsoft reported this morning. Remember, with Microsoft being the world's largest publicly traded company, it's going to have an outsized impact on market cap weighted indices like the S&P 500. So the S&P 500 was actually showing some extreme bullishness first thing out of the gate this morning, and it looked like we were going to be closing the week strong. And of course, remember today was options expiration day as well, so maybe a little bit more volatility and volume as a result of that. But nonetheless, the point that I'm trying to make is it didn't end so well for the bulls. You will see that we have what's known as a bearish engulfing candle here today, as today's body did engulf yesterday's body. And remember, yesterday was a pretty nice little bounce back. So, we've had 4 out of 5 down days here, or at least 3 out of 4 on the S&P 500. Now, before we get a little bit too worked up about a couple of down days, let's keep in mind context here. We still have that bullish posture. The intermediate line is still at 89.88. Remember, as long as it's in the upper reversal zone, we consider that to be bullish. But in addition to that, we don't have any major broken levels of support. We do have a rising 30-day moving average. Remember, our moving average will turn green like it is right now if price is above a rising moving average. It'll also have the ability to turn red and yellow under different circumstances as well. But generally what we're looking for is a green background and a green moving average. That generally bodes well for those of you that want to be a little bit more bullish. So while we've kind of hit the brakes a little bit here, we're not to a point of hitting the panic button quite yet, and I don't think many of you are, but sometimes it makes you wonder just some of the things you read on Twitter or hear on TV. So anyway, we'll see what next week brings. Of course, we continue our journey through a lot of earnings reports, as this first 3 weeks will kind of be the biggest portion of the earnings reporting season, and so that will have both opportunities and of course some risks involved with that as well. And then of course you got all all kinds of other news stories. We heard Boeing came out here today, reported that they were going to have to book a $4.9 billion loss, but the market actually responded positively to that. Of course, I mentioned the news regarding Iran. We're going to have more information coming out of the Fed and whether the market is correct in its assumption that there will for sure be a 25-point cut, and some folks even thinking that there might be a 50-point cut. So a lot of different things kind of going on right now for it to be kind of the summer doldrums, as they say. One other thing I did want to point out here is that we've got a couple of intermediate bullish confirmation signals going on. And remember, those signals occur when we have a bullish intermediate line, and so I'll point out again that the intermediate line on the S&P 500 is above 80, and so we would consider that bullish. Down below here on the NASDAQ composite, it's actually at 92, so of course that's also above 80, and we would consider that to be bullish. And it's also bullish over here on the Dow Jones, as that one is at 93. So all three of those would be eligible for a bullish intermediate confirmation signal. Now, the second piece of the puzzle is whether the momentum line, which is the red line on the chart, is in the lower reversal zone on the same day that we have a bullish posture from an intermediate term perspective. So that does eliminate the Dow Jones. You'll notice that the red momentum line is just a little bit above 20 right there. So it's at 25 here currently. So that lower reversal zone that I referenced is at 20 and less. But that also means that over here on the left side of the chart, we do have the S&P 500 and we do have the NASDAQ composite, both with their red lines in the lower reversal zone. Now also note that both of those are above 5. Now remember, even if it was below 5, it's still a bullish intermediate confirmation signal. It's just not as good of a setup. So these ones are at 8 and at 9. And so while they're maybe a little bit lower, showing a little bit more strain with us closing near the lows of the range. In fact, we were dead at the low on the S&P 500 and very near it on the NASDAQ in just a daily trading range. So there's maybe a little bit more concern there, but nonetheless, the setup does exist. And not only that, you will also notice that the near-term line, the blue line, is between 50 and 20. On the S&P 500, it's at 31. On the NASDAQ composite, it's at 34. And again, that's not part of the bullish intermediate confirmation signal, but just over time, David and I have noticed that the signals seem to work better when the blue line is in that range between 50 and 20. So it's good to see that as kind of a side benefit of the way that this is established right now. So bullish intermediate confirmation signals, along with price still above rising 30-day moving averages. Yes, there's a lot of news out there. There's a lot of scare tactics, but it does seem like, if you're waiting for a pullback in price, then, perhaps you at least have one. You're not maybe getting that big whoosh lower like we saw in May, but nonetheless, if you decided not to buy at all-time highs there on July 15th, you did yourself a favor, as you're now able to buy the S&P 500 at lower than 3,000. The closing price here tonight and for this week was 2,976. All right, let's go ahead and take a look at our next chart setup. And this one will be our 3 green arrows chart setup. This is chart 4C for those of you that are premium market scholars that are following along at home with your own charting package. And remember, chart 4C is going to be looking at whether a chart has either 3 green arrows, 3 red arrows, or a mix of green and red arrows. And the arrows I'm referencing revolve around 3 different technical indicators: the 30-day moving average, the MACD histogram, and the stochastics. And as you can see here, the background colors on 3 out of the 4 charts are white. So right there it's white right there, and it's white right there. But where it's not white is over here on the Russell 2000. You'll notice there it's pink. And what pink refers to is the fact that we now have 3 red arrows on the Russell 2000. Now, it's not a violent movement or anything like that, because to the naked eye, it almost looks like the Russell 2000 closed right on the moving average. But because that red arrow is plotted right there on the chart for us, makes it nice and easy from a visual perspective to understand that technically it did close just a hair below that moving average. And it already had a red arrow here on the MACD histogram. That has been in existence since July 11th. And then we got a phantom red arrow down below here on the stochastics on July 16th. So again, one more indication indication that of the 4 major indices out there, it is the small cap Russell 2000 that seems to be the laggard yet again. That seems to have been a theme here over the last year or so, as the small caps just can't seem to keep up with some of those larger cap companies out there. Let's go ahead and take a look at our next chart setup now. And this one will be chart 4D, and this is our 1040 crossover method. Now remember, David usually does these videos on Friday, and he's out of the office here today, taking his family on a little bit of a weekend trip there, so I'm filling in for him tonight. But remember, usually it's Friday that's the important day to look at this particular chart setup, and the reason for that is this chart 4D is going to look at a weekly candle, not a daily candle like the other charts that we look at. This is a weekly candle, so the indications that come from a chart with weekly candles are not set in stone until Friday's close, like we have here today. So as we look at this, you know, there is one thing I do want to point out down below here again. I hate to keep on dogpiling on the Russell 2000, but you know, you got to call them like you see them. And right now, the Russell 2000 is showing us yet again why it's the laggard. Notice here on this chart, we've got a red arrow showing up. Now note the background color of the chart is green. So the background colors on this chart 4D are going to reference whether we have what's known as a golden cross or a death cross, using the 10-week moving average in orange and the 40-week moving average in blue. And when the orange line goes above the blue line, it plots a green background. When the orange line falls below the blue line, it plots a red background. So remember, those don't move, you know, every single week one direction or another, unless you have kind of some bunched up candles where you're not seeing a whole lot of directional nature out of the market. And that kind of describes what we've seen here over the last, let's call it 2 or 3 months. Normally, once you have a crossover, you have a long extended stretch like we saw here with these other charts that are mostly painted green for the last 3 years here. But with the Russell 2000, it's been a little bit different. Some head fakes back and forth, and just kind of seems like it doesn't know where to go. In fact, I know a big part of David's options inventory class that he teaches on Wednesdays has really benefited from the Russell 2000 going nowhere, because it's part of his options inventory dedicated to selling iron condors. And when you have price that goes essentially nowhere for 3 or 4 months, you know, you're a happy camper if you're selling iron condors. So anyway, some of you might be pleased to see that price action, but for those of you that want to be more directional with your trading, a little bit more speculative, where you're making money a little bit more off of delta as opposed to off of theta, then it could be a little bit aggravating at the same time. So anyway, we do have a bullish crossover of the moving averages themselves, but what the red arrow denotes is that price has now closed below the moving average. So remember, the moving averages themselves haven't crossed, but if you ever are going to get across of the moving average, one of the things that has to take place is eventually price has to go below the moving averages. So for example, over here on the Russell 2000, we had a red arrow back here on September 24th of 2018. If this orange line was eventually going to cross below this blue line, it has to start with price action coming below the moving average. Now, also note there are going to be plenty of times where, you know, it's just a little bit of a warning sign, but it doesn't lead to anything. Think of it like you would see clouds in the sky that does not lead to an actual storm. And a lot of these over here were exactly that. You know, we had a lot of red arrows over here where the moving average didn't end up crossing each other. So we'll note this. We don't have to get worked up about it and, you know, all rush for the exits at once or anything along those lines. But do note there's been a little bit more strain, a little bit more, you know, selling activity, I guess you would say, amongst those small caps, at least in relationship to how the large caps are holding up a bit better. Let's go ahead and take a look at some other charts now. Let's go to 4E. This is our 12 grid analysis. Now, as a reminder on the 12 grid analysis, the background colors of the charts will tell us whether we have a bullish or bearish posture using the intermediate line or the green line on the market forecast technical indicator that you can find over on the Thinkorswim platform. So, as you can see here on chart 4E, where we're looking at our inner market analysis 12 grid, we have a mix of green and pink background colored charts here. So, Let's look at some that might stand out. First of all, the VIX was up today. Not a surprise there. Remember, typically when the stock market is down, the VIX goes up and vice versa. Let's not get ahead of ourselves. We still have a VIX that's only at 14. Now, I suppose that's better than where we were a while back when it was only at 11, but nonetheless, we are a far cry from some of those levels above 20 that we experienced there in May. So yes, it went up, but it wasn't at an alarming rate or anything along those lines. The US dollar has been something that a lot of us have been kind of keeping our eye on here recently. It's been all over the board. Now remember, I was with you on Tuesday, and it would have been on this candle right here on the 16th. And I mentioned during that market outlook video that, it was a very impressive bounce off of the moving average area, but be careful around this area because this is where we have experienced a prior, horizontal resistance area. In fact, I was talking about how there were 3 different touch points. I was talking about this one back here, this one back here, and this one back here. So lo and behold, the next 2 days, US dollar actually fell pretty precipitously. Now, it did bounce back here today. Sometimes the US dollar can be viewed as, a little bit of a safe haven when the conditions are a bit stormy like they were here today. And so we'll have to keep our eye on it. But do note that we still have not surpassed that key level that I discussed on Tuesday. So that remains. If we're going to make a big move higher on the US dollar, it's got to get up and past those levels that I mentioned at that time. So right now we have that bullish posture. That's a good sign if you want to be bullish the dollar. Now, remember, some of you don't necessarily want to be bullish the dollar because you want to be long commodities or long foreign stocks or different things like that. But, same thing. You're going to watch it with interest, whether you want it to go up or down, because that will be a key area. And whether it uses it as resistance or whether it slices through it, it'll tell us a lot of information there. So another thing that I thought was kind of interesting today was that gold, after having a really stellar run here lately, was actually down a hair today. Now, it's only down 0.1% or what have you, so it's not the biggest deal in the world. Now, these are the gold contracts here as well. Let me check this. Let me check GLD. Yeah, I was going to say that candle looked a little bit stronger than just a 0.1% move. So remember, when you look at /GC, that's a continual futures contract there, so we've already rolled over to the new time period. With GLD, that's like any other stock. It's going to end up just stopping trading at the end of the day like other stocks do. So this will be a little bit better for our discussion here. Gold was actually down about 1.5% today. Now again, we have to remind ourselves that gold is up about 12% or thereabouts in the last 3 months. So to go down, 1.5% is not the end of the world. It has certainly not broken its trend. But the reason I found it interesting is I would have figured that today it would have been a day where perhaps you would have seen a spike. There was already a lot of, pent-up bullish activity that was taking place in gold. And then when you hear this news about Iran and the British oil tanker, you probably think that that money would start drifting over towards gold. But maybe it was just profit taking. We'll just have to keep our eye on it. Right now, it remains a very bullish asset, and there's a lot of really interesting gold charts out there. I've talked about a number of them in these presentations over the months, including KL, which is Kirkland, and then we also have so that's KL. Show you here just in case I didn't enunciate there. KL, that's a very strong looking chart there. Royal Gold is a pretty good one as well. That's RGLD, very strong chart right there as well. And then even some of the junior miners. So JDXJ would be an ETF that tracks the gold miners from a smaller perspective. So you have your senior miners and your junior miners. This is the junior index. And for those of you that think gold is going to skyrocket, a lot of times the thought process is that there's going to be a lot more juice out of the smaller players out there. And so for those of you that feel a bit more speculative and you think gold is really going to take off, then GDXJ is one that perhaps you want to keep on your screen. We've also looked at smaller players. There's GFI right there. It's done reasonably well. NG, Nova Gold, that's a little $6 stock, but you can see it's up about 55% here in the last 3 months, with most of it occurring just since the beginning of June. So a lot of really interesting price activity there with not only gold, the commodity itself, but then its associated miners. So keep that on your screen. That's one of the areas that seems to be working quite well in the market right now. Other things that are worth mentioning, REITs got really hammered here today. Note that REITs were down over 1.6%, and that's not a very good sign. This already back here was a very aggressive pullback that we experienced going into the end of June, but I was very impressed with how quickly it was able to snap back. In fact, I remember talking about it on probably one of these 2 days right here where it had those really big candles. I was thinking, wow, there's a lot of resilience there in the REITs. We all know the REITs have gone up dramatically here over the last year, but at some point, every great trend is going to end, and it makes you wonder if we're getting a little bit long in the tooth because, as most of you are aware, REITs are largely driven by interest rate activity, and interest rates have already fallen substantially. So the question is, can they fall even further? And if so, can the REITs continue to rally? And that's where we're starting to have some question marks here, because you'll notice that a pattern was broken in this most recent move with VNQ. I wasn't as concerned about it here. Yes, that was a more aggressive pullback than I would normally like to see, and I don't like to see it slice through that 30-day moving average as aggressively as it did. But, within a week, you were largely kind of, appeased to a degree with how strong the bounce back was at the same time. The problem occurred right here. So this was not as big of an issue. This was a much bigger issue. The reason for that is we ruined the pattern of higher highs and higher lows. Notice back here, the REITs were in a very clear pattern of higher highs and higher lows. So even right here, this would have still been considered a higher low. So that was not the problem. The problem is that we do not have an associated higher high with it. This is now considered a lower high. And we might be in a little bit of a triangle here. Who knows if we break out one way or the other. But what we do know is, if we are ever going to change direction in trend, it's got to start with, lower highs and lower lows. Right now we have lower highs. We don't yet have lower lows, so we're playing the waiting game here. What it does have going for it is that the moving average itself is still tilted higher. So the path of least resistance continues to be the upside, but with as much aggressive price activity as we've seen here in the last month or so out of the REITs, it's kind of like a car going down the interstate at 150 miles an hour. You start getting to a certain speed, your hubcap starts falling off. It gets a little bit unwieldy, and that's kind of what it's like when you start seeing these really big candles at the end of a dramatic run like we've seen. So we want to keep our eye there on REITs as well. All right, let's go ahead and take a look at our next chart setup. This will be chart 4F. This is our foreign stock markets. All right, so as we look at this, you will see here, it's kind of a mixed bag. We've got a lot of greens, we've got a lot of pinks. And as it stands right now, I would say that the leading area appears to be Australia, as Australia was one of the few charts on the board that actually ticked to a new multi-month high here today. Now, we did give back a lot of the earlier day gains, but we still finished in the green on EWA. That was up 0.18% here today. Of course, it remains in a significant uptrend above its rising 30-day moving average, and the green background color of the chart reminds us that its intermediate line on the market forecast is considered bullish right now. The other bullish charts out there are South Africa. Remember, that is also to a degree hooked into gold, what I was mentioning before. We also have Canada, speaking of which. Canada also is a resource-rich country, maybe a little bit more on the oil side than South Africa would be, but you have to remember that Barrick Gold, one of the largest gold mining companies on the planet, is headquartered up in Canada. And then we have Russia, that's also a resource-rich nation that is driven more so by oil than by gold, but nonetheless plays into that theme a bit. And then to stick with that theme, Brazil is also a very resource-rich nation out there, and its chart looks reasonably strong as well. Some of the areas that are a bit concerning, I would say, are India. As you can see, India is in the process of putting in lower highs and lower lows right now. Note that the moving average is now red. Price is below a falling moving average, and the intermediate line is now below 20. It's at 19.99. Anytime it's below 20, it's considered bearish according to the market forecast technical indicator. So that one's concerning. Another one that's concerning is Mexico. Now, Mexico is not at a multi-month intraday low, but you will note that it's at a multi-month closing low as of today. It closed lower by 0.86% here today, and it's had 4 straight down days, bouncing off the 30-day moving average in the wrong direction, right? A lot of times that 30-day moving average can be used as support or resistance. In the case of Mexico, which has seen a lot of wear and tear here over the last 3 months, every time it goes up to that moving average, it doesn't seem to have a whole lot of traction beyond it, and it bounces it right back lower. So Mexico looking a bit more concerning there as well. And then I'll throw Germany into the mix as well. Maybe not quite as ugly of a chart there as what we saw with Mexico, but nonetheless, Germany is now trading below a falling moving average there as well. So anyway, some interesting activity out there from a country perspective. And the theme seems to be whether you are considered to be a resource-rich country or not. And the ones that are kind of dedicated to commodities are doing a little bit better in this environment that we find ourselves in. Let's go ahead and now take a look at our next chart setup, which will be chart 4G. And this will be the United States. And remember, the S&P 500 is a chart in the upper left of chart 4G, and then the 11 charts that follow it will be the 11 different sectors. And as a reminder, those of you that are premium members of Market Scholars should be able to load this up. I have a tutorial and some of the shared Thinkorswim links that you can easily import in the resources area of our blog. But anyway, this will also show you, if you're not familiar with the various ticker symbols, the labels of the sectors themselves. So XLC is communications and XLK is technology, et cetera, et cetera. So as we look at this, you know, it's a bit of a mixed bag here as well. What I would say is that the chart that appears to be the strongest from a trend perspective is the staples. Now, it had a very ugly candle today, so that's why we can't get too excited about it. Who knows? Maybe this is the topping point. We'll just have to see where this takes us. But we did have a bearish engulfing here today. It did close lower by 0.63%. Nonetheless, the trend itself, if you're just to, forget about looking at the colors of the candles and only look at the candles themselves, clearly that has been a very consistent chart to the upside. So that's the one that probably looks the most appetizing. Technology is decent as well. Note that technology hit a multi-month high here today. A large part of that was around what I mentioned in the intro, which is Microsoft. But nonetheless, you look at this chart, it doesn't look as strong as the staples. The staples has been more consistently higher during that time, whereas technology, being a bit more cyclical, has more strong moves lower and then strong moves higher there. You can see over the last 3 months, the staples are up 5.36% and technology is up 3.45%. So from that perspective, staples have a slight advantage as well. Charts that are maybe a little bit more concerning from a sector perspective, I already addressed one of them, and that's real estate. That's not looking very strong here. In fact, we had a good question about this yesterday in my question and answer session. Remember, for those of you that are premium members of Market Scholars, David and I hold what's known as question and answer sessions. You can kind of think of them as Ask Me Anythings or AMAs. And it's basically we just sit there for a couple of hours and answer your guys' questions about the markets. And my class yesterday was 2.5 hours, as they typically are. And one of the conversations was around interest rate sensitivity and how interest rates affect things like real estate and utilities and how they don't necessarily affect things like master limited partnerships as much as you would think, and et cetera, et cetera. So if you're interested in that particular topic, make sure you go back and check out the recording that's available to those of you that are premium members. But anyway, real estate continued its move lower that it had really initiated ever since topping out here on the 10th of July. And that is a very ugly end to the week there, right? It didn't end with a whimper, it ended with a bang. And so that's going to be not only an ugly looking daily candle, but if we were to switch this to a weekly candle, let's just do a 1 year weekly here. Look at that candle right there. Now, it's not the biggest candle we've seen on the board. You can see that over here in December when the stock market was plunging, the size of that red candle was even worse. You did have a couple of more down days, or a couple more down weeks, I should say, after that, and then it kind of stabilized and got into its current trajectory. So we want to keep our eye on that. We recognize that the REITs have been strong for a long, long time. But, as I mentioned earlier, every trend will eventually end. We make the assumption that it won't until we start seeing significant evidence of an ended trend. And right now, we're starting to get a little bit closer to that thought process with the REITs. If they start breaking down major levels of support and giving us lower highs and lower lows, remember right now we just have a lower high, then we're going to have to be mindful of that. And I think we do still own a couple of REITs in my Monday top-down trend trading class as well. So we're going to have to keep our eye on those. We have been selling them recently. So I know we sold a healthcare REIT here more recently, but we might end up having to unload a few more of those if this price action continues with real estate here. All right, let's go ahead and now maybe have a chat on the internet real quick. Just want to say thank you to everybody who clicks the word like on our Twitter accounts whenever David and I post these there. Remember, we try to make it nice and easy for you to do that if you so desire. We have this embedded directly on our website. For those of you that watch the videos on our website, you can just click this little area below the video and click the heart right there. We also send the link to you in the email that we send those of you on our email distribution list. We also have the Twitter link on our description area on the video itself for that particular day. And of course, you can always just go to our Twitter feed where you'll usually find it near the top. But remember, that benefits you guys whether you know it or not. I know it kind of feels like, boy, do I have to click like every single day? Well, remember, that's what we view to judge whether these videos are worthwhile or not. So if you are getting benefit out of these videos, it is to your advantage to click like every single day, because if everybody en masse just decides not to click like, David and I will get the hint and we'll just stop doing the videos. On the other hand, if our numbers continue to grow and stay strong, we'll understand that the pressure is on for us to continue doing the videos. As an example, as I mentioned before, I normally don't do the videos on Friday. David does, but he's on a 3-day weekend here with his family and asked if I could fill in. Normally, I'd hesitate a bit because, as most of you are aware, Friday afternoons after the stock market closes and all the numbers are in is when I spend a couple of hours building out my sector selector tool for my own classes. So I'm a little bit hesitant to sub for somebody else at a time that I've got my own work to do, because what's going to end up happening is it just pushes all of my work later into a Friday night. And I don't know about you guys, but I would imagine most of you probably don't enjoy doing things like that late into a Friday night. But because I know many of you do appreciate these videos, it puts the extra pressure on me to say, all right, I'll suck it up, I'll sacrifice, right, and do the video, because it's either say yes and do the video, or say no and do the video on Monday instead. So anyway, a little bit of background there, but of course the reason we want you to engage with us on Twitter is it helps share that information to people we wouldn't be able to reach without you. That is the benefit of social media. So if you guys can do us a favor, click the word like every single day. It will end up benefiting everybody involved, both us as a firm and you guys, because we're going to continue to watch these videos. All right. Another thing that I wanted to address real quick before we get into our trade application example, you'll notice here that about 6 hours ago, I posted on Twitter this particular tweet. I said the Occidental price action is starting to get interesting after lagging for some time after announcing its deal to buy Anadarko. It has outperformed XLE on a relative basis over the last week, establishing a series of higher highs and higher lows above a rising 30-day moving average. Now note this was 6 hours ago, and this is, I'm doing this video right now just after the market close. And so the point that I'm trying to make is, I was posting this on Twitter before the news about Iran and the British oil tanker hit, and after that, oil prices spiked even higher. So that is the benefit of following David and I on Twitter. A lot of times we will tie in what we're going to reference or talking about on the most recent market outlook videos into what we're seeing during the trading day itself. So you'll notice at that time that I tweeted it out, it was trading a little bit below 52, but even then, it was starting to firm up very, very nicely in comparison to a lot of other oil stocks. You can see it's been a really ugly move lower for Occidental after they've been involved in some of that merger and acquisition activity. Well, that deal is about ready to close. If I heard it right, I think the deal gets done next month. And so right now, there's probably a lot of arbitrage traders that are involved in the name. After the deal gets officially done, those arbitrage traders will leave and go find another merger situation to dabble in. At that time, Occidental can hopefully get back to its old ways of doing business. And as long as oil prices stabilize or head higher, then perhaps this is one that could also go a bit higher. This is one that has raised its dividends for more than 10 years in a row or more, and it does have a yield of about 6% right now, which is a historically high yield for Occidental. Normally it doesn't have yields anywhere near that close, but because prices have fallen and dividends have continued to go up, its yield has also gone up. Now, before we get into the trade idea, I do want to make sure that you're aware that we do have earnings coming up here in 8 days, as you can see up here. So for those of you that do not like to trade through an earnings announcement, you're probably going to want to skip this particular paper trade here. But again, I would stress that if you're not following me on Twitter already, go to @BrandonVanZ, click follow, and do the same for David, because oftentimes you'll get nice little pearls like this before action breaks. And if we are to head back on over here now to the Paper Money account, I'm going to show you what the chart looks like here currently, because it actually did improve in a meaningful way. And so I'm going to type in ticker symbol OXY for Occidental Petroleum here. Now, the reason I said that it improved in a major way, you can see that it ended up closing up about 30 or 40 cents higher than where it was when I tweeted that out this morning. And a lot of that was based off of the fact that oil prices across the board started going up after the Iran news broke. But why it was important specifically for Occidental Petroleum is we ended up closing at the highest level in over a month, right? When I was on that tweet a second ago, maybe you caught it, maybe you didn't, but note that where it was trading right there at just under 52 bucks, it was actually a little bit lower than the high price of this candle just, a week or so ago. So I was really happy to see that after I had made that tweet talking about higher highs and higher lows, I was kind of referencing this low, right? And this high and this high. But even after doing the tweet, it has helped one more time, because now we have an additional higher high that we're dealing with. Well, not only that, you can see from a market forecast perspective, we now have a strongly bullish posture here as well. The green background color, especially the dark green, signifies that. You can see that the price of the reading of the green line is in the upper reversal zone right now. It's at 85.93. So we have higher highs and higher lows. We have price closing basically at a 1 month plus high. We have relative outperformance. So that was the other thing I mentioned in the tweet. So if you look at XLE, which Occidental is part of, this is the ETF that tracks all of the major oil companies in the United States, you'll see that XLE has been taking a bath this week. Yeah, it perked up a little bit today off of the Iran news, but nonetheless, we're clearly lower over the last week on XLE, whereas on OXY, we are clearly higher over the last week. In fact, we're at our 1 month high right now. So this one's interesting from another perspective as well. Many of you may have caught the news regarding the merger itself and how Warren Buffett got involved in the deal. Now, how he got involved was he bought preferred shares from Occidental. In fact, it's going to be very expensive financing for Occidental themselves. But the point that I want to make is, as part of the deal, he also received warrants to purchase Occidental stock at $62.50 if he so desires. Now, of course, he's only going to want to do that if the stock is trading at $62.50. We're a long ways from that right now at only $52.33. But nonetheless, something to think about out there. Under the right set of circumstances, if oil starts cooking to the upside and we get the right set of geopolitical, environment and news stories, oil could start popping. And the other thing to remember is a lot of times when a stock market cycle ends, it's when oil and materials are firing on all cylinders to the upside. That's what we saw in 2008, as a reminder. Oil was up at $150 a barrel. So there's a lot of people that feel that if we are going to get a blow-off top type of a scenario with the overall stock market in this current 10-year run that we find ourselves in, that eventually oil and materials will have to participate. And right now, they just haven't, at least here recently. And so that would be maybe another thing as a catalyst in the back of your mind to start thinking about if you want to try to have some exposure to that, what are the names that you want to have exposure to? And if this particular stock can find itself above $62.50 in coming years, an additional catalyst would be that Warren Buffett could eventually become one of the largest shareholders of the company. So because of the unknowns from a timing perspective, what we're going to do today is going to be more speculative. I'm going to come over here to the trade tab. I've got Occidental Petroleum pulled up down here, down below, and you will see that the strike chains are all loaded up down below as well. And I'm actually going to go to the one that offers the most amount of time, 546 days until these expire. So I'm looking at the January 2021 contracts. So these will have, another year and a half of life to them. So it gives you a long time to be sitting on them if you think that there's some catalysts out there, you just don't know when they're going to take hold. Now, the other benefit of doing something like a leap as opposed to just buying the stock outright is you don't have to spend as much money. If you were to buy 100 shares of Occidental Petroleum right now, you'd have to spend about $5,200 to do that since the stock price is around $52. But if you buy a call option, you can spend less money to be able to access 100 shares. Now, we also have to remember the flip side of buying a call option is that you have time decay working against you every single day. So more times than not, you're not going to want to buy a call option. But it can certainly work. In fact, those of you that have been following me over the last year know that I've been trend trading long calls on Starbucks, and we've rolled them 3 or 4 times along the way. In fact, we're very close to having to roll them again. So when that right type of scenario unfolds, they can be very, very profitable because of the leverage that's involved on a percentage return basis. So what I'm going to do in this particular case is rather than looking at something from a delta perspective, remember a lot of times we look at, let's say, a 70 delta or something along those lines. In this case, I'm going to do something a bit different because of the knowledge of Warren Buffett's involvement in the deal. If the stock is going to get up to 62.50 where Buffett will eventually benefit handsomely, then it's going to have to pass all of these other strikes along the way. And so, there may be a certain group of traders out there that know that it's going to capture a lot of attention if the stock starts getting to 62.50. And so that's where I kind of want to hunker down around that same area as well. Now, you could go out and actually buy the 62.50 itself. You can see that's one of the ones out there that has the most open interest, as a matter of fact, 1,600 contracts there. But the problem is, you'd have to pay about, let's call it $2.50 for that. So your true break even on the trade, if the stock were to go up, would actually be $65, not $62.50. So I'm actually going to concentrate on the 57.50s in this particular case. You'll notice the 57.50s have a bid of 375 and ask of 405. So as always, you're going to want to use limit orders, of course, especially when you're going this far out in time and you don't have as much liquidity as you would with nearer term contracts. But you'll note that if you get filled somewhere around, let's call $4, somewhere between the bid and the ask, you'll note that the last trade, by the way, was at $3.75 here today. So if you got filled at $4, then your break-even price is actually going to be, let's do the math here, $4 plus, hang on just a second, $4 plus $57.50. And so that's going to be $61.50. In other words, if Buffett's ever going to, end up having to convert his warrants into shares and benefit from that, at least in the next 546 days, then it's going to have to go up and through $61.50. And you would at that point be also, benefiting from that type of behavior. Now, if you do that, remember that $4 that you spend on that could be 100% loss, right? This is a speculation. This stock is nowhere near $57.50 right now. This that's worth $4. This contract that's worth $4 today could be worth $0 at that time. So the way that you got to think about this is position sizing. We're just going to do one contract here. We're going to say rather than spending $5,200 on the stock right now, we're going to spend $400 by buying one contract at $4 per share. If the stock does go up dramatically under the right set of circumstances, then we can convert that call contract into 100 shares of stock at that time. But until then, our worst case scenario is that we would end up losing $400. So whether you can afford to lose $400 or not, it depends upon who you are. Saw a comment about that on Twitter the other day too. I'm thinking, well, everybody's different. For some people, $400 is a lot. For some people, it's an afterthought. So you'll have to make that decision for yourself. But nonetheless, that's one way to kind of look at this situation. If you believe there's going to be a big bull market blow off top where the business model cycle will allow oil stocks to really start rallying, if you believe that stocks will start drifting in Buffett's direction that he is hoping it goes in, or if you just think there's going to be a lot more chaos in the Middle East and oil prices start going up as a result of that, there's a lot of different potential catalysts that could be hitting this particular stock. So with that, we're going to go ahead and buy the 57.50 call in January 2021 contracts by clicking on the ask price right there. And I will try to get filled at $4. Hopefully it actually opens up lower than that on the open on Monday, since the last traded price was actually $3.75. But I'll be willing to spend an extra $25 since I'm only doing one contract here, just to be on the safe side. Now, if it doesn't get filled that day, I'm also going to change this to a good till cancel order, and that way, if this somewhat illiquid contract doesn't get filled on Monday, it has the chance to get filled Tuesday, Wednesday, Thursday, Friday, etc. So, all right, I'm going to go ahead and click confirm and send. There's our $400 that we're willing to lose on this speculative trade idea, and we'll click send. All right, well, thank you for joining me here tonight once again. David should be back with you on Monday. A lot of different balls in the air right now from a news perspective, but largely we still have bullish trajectories on the market despite the pullback here this week. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.